I want you to think about what a dollar used to be before you think about what a dollar is becoming. For most people, the story starts with oil. It does not. It starts with definition. It starts with restraint. It starts with the difference between money that has to be earned and money that can be manufactured in 1971. The United States closed the gold window. That one decision changed the moral architecture of the dollar. Before that, the dollar still carried a visible chain to something scarce. After that, the chain was cut. The dollar was no longer a claim on gold. It became a claim on trust now. Trust can carry an empire for a long time. It can carry a balance sheet even longer. But trust alone is a fragile foundation when the asset being trusted can be created without limit. That is why the real story begins in 1974. America needed a new anchor for a currency that was no longer anchored to gold. So Henry Kissinger went to Saudi Arabia and struck the arrangement that built the modern financial world. Saudi oil would be priced in dollars. The dollars earned from oil would be recycled back into U.S. treasuries. In return, America would supply military protection and weapons. That arrangement was elegant for one side and binding for the other. Every country on earth needed oil. If oil had to be bought in dollars, then the world had to hold dollars. It had to settle trade in dollars. It had to save in dollars. It had to own American debt in plain English. The dollar stopped being backed by gold and started being backed by the thing the modern world could not function without: oil. That is what people mean when they talk about the petrodollar system. And most people still underestimate what that system really did. It did not just support the dollar. It created a permanent structural bid for the dollar. It gave America the privilege of borrowing cheaply, importing real goods in exchange for paper claims, and funding deficits that would have broken weaker nations. OPEC then became more than an oil cartel. It became part of the enforcement structure around that monetary order. Its job was not simply to coordinate output. Its deeper job was to preserve a dollar-based oil market that allowed the fiat dollar to keep pretending it still had a hard anchor. That arrangement worked for a very long time, long enough that most people started treating it like nature instead of policy, long enough that they forgot systems built by negotiation can also break by negotiation. Now we are watching the strain show up in public. The United Arab Emirates, a founding OPEC member since 1967, just announced it is leaving the cartel effective May 1. Most people hear that and think energy policy. I hear something much larger. I hear one of America's closest regional partners signaling that the system built 50 years ago is no longer sacred. And the most important detail is not simply that the UAE is leaving. It is what it said before leaving. It warned that if it ran short on dollars amid the Iran war, it might be forced to use yuan or other currencies. That is not a technical comment. That is not diplomatic fluff. That is a threat aimed at the foundation of the post-1974 order. The United States understood the threat immediately. Treasury Secretary Scott Bessent openly acknowledged that Gulf allies were seeking swap lines to maintain order in dollar funding markets and to prevent the disorderly sale of its assets. That sentence matters more than most headlines you will read this month. Why? Because it is an admission that the Gulf states hold enough American assets that if they begin selling them to defend their own systems, they can destabilize us markets. The Gulf Cooperation Council collectively holds over $2 trillion in American assets. That is not trivia. That is leverage. When your ally can credibly imply that selling its dollar assets would disorder your market, you are not watching a normal alliance. You are watching a creditor remind the debtor that the relationship has become reciprocal, and this did not happen in a vacuum. It happened in the middle of an energy crisis tied to war, shipping disruption, and the choking of the Strait of Hormuz, one of the most important oil arteries on Earth. To understand why this matters, you have to look at the arithmetic of the Gulf. The Strait of Hormuz carries an enormous share of the world's oil and gas trade every day. Saudi Arabia, the UAE, Kuwait, Qatar, Iraq all depend on it. When Hormuz is effectively constrained, Gulf exporters do not just face inconvenience, they face a revenue crisis. Their budgets are built around continuous export flow. Take Saudi Arabia before the war. Saudi Arabia already needed oil around $100 a barrel just to fund its domestic obligations, imports, and social spending. It was exporting roughly 7 million barrels per Dalton Y into that structure. If the route that carries those barrels is constrained, then the price required to offset the lost flow rises dramatically. One economist's estimate put the equivalent at roughly $170 oil. Oil is not there, which means Saudi Arabia bleeds, And when Gulf countries bleed, they do not just suffer lower profits. Their currencies come under strain because many of them still operate with pegs to the US dollar. Pegs sound stable when reserves are abundant. It becomes a trap when reserves begin draining and your export machine is damaged by a war you did not choose. That is the context for the UAE pressure campaign. It is not random. It is not emotional. It is simple survival mixed with strategic leverage. And if you want to understand who is winning this contest, you have to stop looking only at missiles and start looking at plumbing, financial plumbing, commodity plumbing, industrial plumbing. China has been preparing for this kind of moment for years. Look at the sequence. The UAE Crown Prince meets Xi Jinping in China. The UAE and China signed 24 separate trade and investment deals to push bilateral trade beyond $100 billion. Then comes the yuan warning. Then comes the open discussion of dollar swap lines from Washington. Then comes the UAE's exit from OPEC. That is not a coincidence. That is a sequence. The UAE strengthened its relationship with China first. Then it turned to Washington with a stronger bargaining position. In effect, it put the alternative on the table before asking America for relief. That is what intelligent negotiating looks like in a multipolar world. China's advantage here is not rhetoric. It is preparation for decades. The United States operated as if paper claims and financial engineering were enough. China spent those same decades building things, securing resources, dominating processing chains, and quietly constructing an alternative settlement architecture. You can see it in rare earths, you can see it in industrial supply chains, you can see it in payment rails, you can see it in oil trade. America still commands the most powerful financial system in the world, but financial power is not the same thing as material sovereignty. You cannot fight wars with PowerPoint slides. You cannot build missile interceptors with treasury paper. You cannot sustain a long industrial confrontation if the components, minerals, and processing capacity live somewhere else. That is why Besson calling China an unreliable trading partner sounds hollow to me. The harder truth is that America has allowed itself to become strategically dependent on supply chains that can now be turned against it. Rare earths, tungsten, specialty inputs, these are not decorative items. They sit inside the military-industrial stack itself. So when people say China is winning, what they really mean is China has spent years building the real-world systems that still matter when trust begins to fray. And trust is fraying. The world noticed what happened to Russia's reserves in 2022. When the United States and its allies froze Russian foreign exchange assets, every central bank in the world learned the same lesson at the same time. Dollar reserves are not just reserves. They are reserves at the pleasure of the issuer. That was a turning point. Back in 2001, the dollar made up about 72% of global foreign exchange reserves. Today it sits in the 50s. That is still dominant, but dominance is not the same thing as invulnerability. Something else has been taking the marginal vote. Gold central banks have been buying gold at the fastest pace in half a century. On an adjusted basis, gold now represents a larger share of central bank reserves than U.S. treasuries. Think about what that means. The institutions most responsible for preserving monetary stability are choosing inert metal over the debt of the world's reserve issuer. That is not nostalgia. That is a trust vote. And while gold has been gaining that role, China has been expanding yuan clearing banks in major financial centers, building commodity relationships denominated outside the dollar, and proving that energy can move through channels the United States does not completely control. Iran sells oil to China outside the traditional dollar framework. Russia adapted. India has experimented. BHP signed yuan-based commodity arrangements with a Chinese state buyer. These are not isolated deviations. They are the early plumbing of a system that no longer assumes the dollar must sit in the middle of every meaningful trade. Now let me tell you where this gets even more dangerous. The bond market is beginning to discipline American foreign policy. I do not say that lightly. But when the 10-year Treasury yield starts pushing toward levels the system cannot comfortably tolerate, political rhetoric softens very quickly. We have already seen moments where yields approached roughly 4.4%. And every time pressure intensified, the language out of Washington shifted toward de-escalation or delay. That is not an accident either. When Treasury yields rise, the cost of funding the American state rises. Mortgage rates rise, credit tightens, asset valuations lose air. The entire financialized structure that has grown accustomed to cheap money begins to creak. So when investors demand higher yields because they see commodity inflation, war risk, and reserve diversification accelerating, they are not just pricing bonds. They are pricing geopolitical credibility. And now Washington is trying to buy time by extending liquidity to Gulf allies through swap lines, so those allies do not have to liquidate dollar assets into a fragile market. In the short run, that may maintain order in the longer run. If Hormuz remains constrained and commodity inflation rises, those same stabilizing measures can feed the very inflation that causes bond investors to revolt. Again, this is the kind of trap mature empires fall into. Every short-term fix worsens the long-term problem if Hormuz remains effectively closed or constrained. The energy shock deepens. If the energy shock deepens, inflation rises. If inflation rises, bondholders demand more yield. If yields rise, the debt burden worsens. If the debt burden worsens, the dollar needs more support, not less. And if the dollar needs more support while trust in the dollar is already sliding, then every patch applied to the system starts looking like further evidence that the system needs patching. That is not stability. That is managed deterioration. There are, in my view, only two broad endgames here, and neither one is clean. Either Iran breaks first. If that happens, Iranian oil remains constrained for a long period, regional damage persists, and the resulting oil spike is enough to trigger recessionary conditions into a bond market that already does not have the luxury of ignoring inflation. Or the broader supply chain breaks first. If that happens, inflation accelerates through energy, shipping, and fertilizer before Iran itself is forced to capitulate. That also leads to recessionary pressure. And it also collides with a bond market that cannot peacefully absorb higher inflation and larger deficits at the same time. Either way, the setup is hostile to the complacency that currently exists in many equity markets. And I do believe there is complacency. Investors are acting as if the world will get an AI productivity boom. I need geopolitical resolution, benign inflation, and manageable yields all at once. I do not build my fortune by assuming perfect outcomes. I build it by noticing when the market price assumes perfection while the underlying structure is deteriorating. Look at the food chain next. Hormuz is not only about crude, it is entangled with fertilizer flows as well. Fertilizer is one of the hidden links between energy shocks and social stress because higher energy costs feed into higher food costs, and fertilizer disruption amplifies the effect. According to the logic in the source document, the Strait of Hormuz handles an enormous portion of the world as fertilizer trade, the same trade that supports food output for billions of people beyond what the planet could otherwise sustain. If that route remains impaired, the next wave of inflation is not theoretical. It moves into groceries, into transport, into farm inputs, into every household budget. Congress has reportedly been briefed that clearing mines in Hormuz could take many more months. If that is true, then time is not the ally of the current pricing regime. Now I want to step back and say something very simple. The petrodollar did not die in one day. Systems like this never do. They weaken in stages. First, the anchor expires. Then allies test the perimeter. Then alternative settlement channels grow. Then reserve composition changes. Then the bond market begins enforcing limits. Then what used to look permanent starts looking conditional. We are somewhere in that sequence right now. This is why I do not treat the UAE's exit from OPEC as a side story. I treat it as one visible crack in a much larger structure, the same structure that allowed America to print claims on the future while the world supplied real goods in the present. The same structure that let deficits feel cheap and asset inflation feel normal. The same structure that made people forget that money with no hard anchor eventually has to rely on power, and power eventually has to be paid for in something more substantial than confidence. If you ask me what this means for an investor, I will tell you it means humility first. It means understanding that valuations built on easy money are vulnerable when the cost of capital stops cooperating. It means understanding that gold is not some relic in this environment. It is a trust hedge. It means understanding that cash is not foolish when the market is pricing in an easy resolution to a difficult problem. It means understanding that commodity shocks can break neat portfolio assumptions very quickly. It also means you stop assuming every dip in every fashionable equity is automatically a gift. Sometimes the market is right to re-rate assets lower. Sometimes a lower multiple is not panic. It is mathematics catching up with a changed world that said, I am not telling you to run around like a scared man in a storm. I am still invested. I still believe in productive assets over long stretches of time. I still believe ownership in strong businesses remains superior to sitting in paper that constantly loses purchasing power. But I also believe this is the kind of moment where cash levels matter, where discipline matters, where exposure to hard assets matters, and where you should not confuse bravado with courage. If the market continues climbing from here, I will do fine. If the market finally starts pricing the real stress embedded in energy, reserves, bond yields, and geopolitical supply chains, I will also be prepared. That is the posture I like, not prediction preparation. People often want a clean ending. They want someone to tell them whether the petrodollar is dead or alive, whether the dollar will collapse tomorrow, whether stocks will crash next month, whether gold will explode, whether oil will reset the whole board. That is not how I think. I think in probabilities. I think in incentives. I think in structure. And structurally, the world is moving away from a period where America's paper promises could command unquestioned obedience. It is moving toward a period where resource ownership, supply chain control, reserve diversification, and hard collateral matter more. In that kind of world, you do not want to be the last man believing a system is permanent simply because it has been profitable for a long time. The better question is always this: what used to hold this system together? And the next question is even more important: is that thing stronger today or weaker today for 50 years? The answer was oil priced in dollars, recycled into treasuries, defended by alliance structure and military reach. Today that answer is weaker. The UAE just showed you that. China's preparation showed you that. Central bank gold buying showed you that. The bond market showed you that. And the Strait of Hormuz is showing you that every single day it remains impaired. So no, I do not think this is just an oil story. I do not think it is just a Middle East story. I do not think it is just a currency story. I think it is a story about what happens when a monetary system that relied on a hidden anchor starts discovering that the anchor can move. And when anchors move, ships drift before passengers understand they are drifting. That is the danger. Most people do not recognize a structural break while it is happening. They recognize it only after portfolios have been repriced, after policy has already changed, after inflation has already altered behavior, after reserve managers have already moved, and after alliances have already been renegotiated. I prefer to notice the drift early. That is why I am cautious. That is why I am willing to hold more cash than usual. That is why I respect gold here. That is why I do not trust the market's current optimism. And that is why I think the end of the petrodollar is not a headline you read once and forget. It is a process you study carefully because it changes how you think about money, risk, valuation, power, and what sort of assets deserve your confidence. When confidence itself becomes the scarcest commodity on earth. There is another reason I take this seriously. When people think about reserve currency decline, they usually imagine a dramatic movie scene. They imagine one morning the dollar is simply gone. That is almost never how these things work. Reserve status decays at the margins. First, settlement choices widen, bilateral deals bypass the old channel. Central banks quietly change reserve mix. Commodity producers begin asking not what is traditional, but what best preserves purchasing power. Then one day people look up and realize the old monopoly became a preference. And the preference became one option among several. That is how empires lose privilege, not with a trumpet. With alternatives, the dollar still has extraordinary advantages. America still has deep capital markets, military reach, legal infrastructure, and a scale of financial liquidity nobody else can match. I am not blind to that. But advantages can coexist with erosion. In fact, that is usually how decline presents itself. The old leader remains the largest player, but each crisis reveals that his strength now depends more on managing expectations than on commanding unconditional trust. And that is why the petrodollar story matters so much to an ordinary saver. If the dollar's global privilege weakens, America does not lose in one clean line item. It loses through a higher cost of debt, a lower tolerance for policy mistakes, more sensitivity to commodity shocks, and a world less willing to absorb its inflation without protest. That eventually shows up in your mortgage rate, in your grocery bill, in your retirement multiple, and in how richly or cheaply the market is willing to value future earnings. That is what most people miss. They think monetary systems are abstract until the abstraction lands in the kitchen. I do not need to know the exact month the market will fully respect that reality. I only need to know the direction of pressure. And the pressure is obvious. More gold buying, more yuan experimentation, more commodity leverage from non-Western producers, more treasury sensitivity, more open discussion of swap lines, reserve defense, and inflationary side effects. That is not a picture of a system getting stronger. It is a picture of a system requiring more intervention just to look stable. When a system requires more effort to produce the same appearance of calm, I do not call that strength. I call that strain.